This is very similar to your paper 3, isn't it? It's essentially the same thing. You need assumptions. So rather than me just giving you the assumptions, you calculate them yourself. So if you think about it, discount rate for a stock, good old capital asset pricing model, risk-free rate plus beta times the market risk premium. So KE equals, what did she say her risk-free rate was? She used the forward rate. She tells you that. So 2.7%. And remember, on the exam, do everything in decimals. Plus beta times the market risk premium. Well, with the market risk premium, we're going to, instead of using the required return on stocks, we're going to substitute the expected return on stocks, which equals the dividend yield of the market, not of your stock, less expected earnings growth of the market, not of your stock. So those are both needless pieces of information right there. You don't need that. You need this, but not in this question. You need it in the next question when you're valuing Best Buy. We don't care about anything on Best Buy. Same thing on your paper 3. Don't give me the dividend yield for your stock. It's always the stock market. So the dividend yield for the stock market is 1.4%. Plus expected growth in earnings equals expected GDP growth, which equals, what does she say, 0.0225 plus 0.0025 plus 0.0 something, 25? I can't remember. So productivity, wow, she's pretty aggressive, 275. Labor growth, 25, inflation, 250. Does that give you what, 5.5%? Is that what y'all got? Anybody remember? I never taught the word growth right, ever. I don't think I have ever. So 5.5%. So that gives you 0.069. Does that sound right? You may get that number. Expect stocks to grow 6.69. So your market risk premium is the expected return on stocks minus the risk-free, which equals 0.069 minus 0.027, which equals 0.042 or something like that. I think I heard y'all saying 0.042. That sound familiar? I don't think stocks has an M in it. Hey, I typed it right that time, but Bill Gates doesn't like it. I don't know why. Okay, so all we have left is the betas. So beta. So start off with what? Yeah, revenue sensitivity. What kind of stock is Best Buy? Cyclical or defensive? Cyclical, consumer, discretionary. Maybe not excessively so, but certainly they sell appliances, computers tend to be higher end stuff. So beta above 1, not dramatically, but in the 1.2 to 1.6 range kind of thing. And then op leverage. What did you see there? What would you expect? Their workers, I think, are hourly, aren't they? Most of them. I haven't talked to. I don't know how the Geek Squad is. They may have some management that's on salary. I don't know anything about how their buildings work. If they actually own their buildings, that would give them more operating, or if they have leases or whatever. But if you look at their earnings, how stable are their earnings? Very, very stable earnings, aren't they, in the top 8%? So I'll say probably hourly workers. So low op leverage and consistent with low standard deviation. net margins 1.46% versus stock market 6.25%. And then financial leverage, the easiest one. Where are they on debt? Below average debt, 37% versus 72. So below average debt versus market. So history, median is 1.50, but much slower more recently. 1.5 seems awfully high for this stock. I might go with the 1.3. What did y'all use? The most y'all use 1.5 because it's right there on the median, but that median's pretty skewed by this period right here. This period, you take that period out, I kind of look at the median since then. So 1.50 is too high given above. So 1.3. So I'd use 1.3 or whatever. And there's, anything you justify makes sense. So 1.30. So something along those lines. All right. And that's exactly what you're going to do on your paper 3. I don't know if anyone watched the video yet, but you can watch the video. I would recommend you follow the video in Excel, and then your paper is taking what you did in Excel and explaining it in a paper with some good charts and graphs. I mean, it works pretty well. So, all right. Hopefully you are getting this. So Thursday, we'll do the bond valuation. All right. So I did finally run some numbers on the buyback yield. On the video, I say it's up to you if you want to do the buyback yield. I think you're going to be better off if you add in the buyback yield. So remember, the buyback yield, expected return on stocks. You have the dividend yield plus expected earnings growth. That's what we just did with Best Buy. But you could add in buyback yield. And why would you add that back in? Well, the expected earnings growth is not the earnings of the firm, but it's the earnings per share. And when a firm buys its stock back, it makes the earnings per share grow faster than the earnings. And that's what you get as a stock investor. So it actually does, the buyback yield does increase your expected return. So we throw it in there because management is artificially increasing, not really artificially, but it is giving us a higher return on the stock. So how much would you add back? The article I provide says anywhere from 1 to 1.5%. But if you look historically, there's 1% right there. The red is the dividend yield. The blue is this buyback yield. I think you could probably safely add back 0.5% up to 1% maybe. It has been all over the place. It's been fairly consistently at 0.8%, and then it jumped up, during the heydays of the 2007, then it dropped back down 2020. Makes sense, although dividends didn't drop down that much. It's much stronger in 2021. I don't know about 2022 yet because I don't have a full year. So you could probably add back 0.5% to 1%, I think would be reasonable. The Barclays study, they added back 0.75%, and that was written over a decade ago with much lower numbers. You can see 2008, 2009, they completely shut it down. But since then, they've been fairly consistently buying back. Now, it's very industry specific. There's some industries that do a lot more than others, but you don't care because you're looking, this is all about the stock market. You don't say, well, I'm in the consumer discretionary industry, so I'm only going to add back 0.25. You don't want anything related to your stock. It's all about the market. So you could justify adding back some. Now this is actually the Russell 3000, not the S&P 500. I should have done it just for the S&P 500, so maybe I'll try that. But all right. So let's real quickly. This is covered in the video very, very well. So we don't need to go through this again. But you're going to use the dividend discount model. If you pick a firm not paying dividends, then email me and I'll help you get free cash flow per share. You should have seen this in 3013. So very, very simple formula. The value of the stock is next year's dividend or this year's dividend times 1 plus the growth rate. On the exam, I usually give you dividend 0, and you have to take dividend 0 times 1 plus the growth rate. But if I give you dividend 1, then you don't have to multiply. Divided by CAPM formula, risk-free rate plus beta times market risk premium minus the growth, or dividend 0 times 1 plus growth, divided by K minus G. Your growth must be less than KE. That's one of the reasons why adding in that buyback yield helps you a little bit, because it gives you a little bit more room for your long-term growth. We assume growth in dividends is the same as growth in earnings. That's probably true over the long term. Short term, it probably is a lot noisier. And this is essentially a perpetual growth annuity. It's how you value cash flow that is growing at some constant rate. The capitalized earnings model. So remember the dividend discount model, you don't have to explain it. You can just put it in the paper. The capitalized earnings model, you probably have to add a paragraph to explain it. So essentially what I'm saying is, what if the firm paid out all of its earnings? If they did that, they couldn't grow very fast because they don't have anything to reinvest in the firm. They could probably only grow by inflation if they do that. And so the implication there is, if they pay out all their earnings, then we'll use earnings per share divided by KE minus inflation to try to get a sense of how much is the firm today worth if they did nothing new. So it's essentially the value of the business without any expansion. And then the H model, you probably have to explain it a little bit as well, but the H model is essentially the dividend discount model, but allowing you to add a little extra for an unusual growth period. So it's the same models before, we're just adding this little middle section into the dividend discount model. And it's pretty easy. Dividend 0 times H times short-term growth minus long-term growth. I don't give you a formula sheet on the final, but this, the dividend discount, if you're a finance major, you know that. And the H model is just adding in a really simple thing to add into the middle. So your short-term growth, I gave you 3 approaches for that. And it's in the video, it talks about that. And then the H is the half-life of however long that shorter period is going to be. So that's probably the hardest thing to do on paper 4, is come up with that half-life, just creative writing. So we'll practice this next week. We'll see if we do one next week or the week after next when we'll practice the stock valuation. What else could you use? There are proprietary quantitative models. I'm not going to show you the one that I have. If you want to look at it, it's in there, but it's essentially the one I built. It's essentially the H model for a firm that doesn't pay dividends. So essentially it just has 0 dividends and it grows. And once its growth rate hits its long-term growth rate, it starts paying dividends. So it's a pretty simple kind of model, but any kind of proprietary quantitative model that you build where you're specifically forecasting out and come up with an answer, you can make up your own thing. There are many other models. The free cash flow model, it's just like the Gordon growth model, except for you use the free cash flow to the firm and use cost of capital instead of KE. Or you use free cash flow to equity and then you use the KE. So if you use free cash flow to equity, this model looks exactly like the dividend discount model. You just use free cash flow to equity instead of dividends. So if you have a stock that's not paying dividends, we'll just find this number and you'll use that instead of dividends. So free cash flow, we can't cover that in this class, but if you take Kata Backham's class, they'll go in quite a bit of detail. Essentially, it's how much cash does the firm have that is free to pay back in dividends, buy back stock, pay down debt, expand the business. It's cash flow management has a choice on. Contingent claim model, we're not going to do those, but they're pretty exciting models. for firms that have something interesting going on. If it works, it's wonderful. If it doesn't work, it costs a little money and you shut it down. So an energy company might have a new oil field they're going to explore. It costs them a few $1,000,000 to explore it. If they don't find anything, you lose a few $1,000,000. They find something that could be worth billions. A pharmaceutical is developing a new drug. If it doesn't work, it costs them a few $100,000,000. If it works, it's tens of billions of dollars. So it's very, very skewed to the positive side. So we essentially use option pricing models that we're going to talk about in future classes. Well beyond the scope of an undergraduate class, but pretty exciting. What this means is firms that have those type of upside potentials, when you use a dividend discount model, any other model, your valuation is going to look really low because you haven't added in this, because none of this is reflected in their cash flows because they haven't done anything yet. They have the option to do something. If they do it and it works, you make a fortune, but it's not in the numbers yet. So you really have to add this on top of it. And then I was taught a multi-stage growth model. I hope no one's still teaching these. They're just ridiculously complicated formulas that take forever. So the H model does a much better job, much easier to deal with. And there's probably a million other models out there. But the ones you have to do for the paper are the dividend discount model, capitalized earnings model, and don't call this, some students call this CAPM. I did not come up with CAPM. Let me assure you, I have not won any Nobel Prizes in the last several years. So it's the capitalized earnings model. My own title won't mean anything to anyone outside of this class. So you have to describe it. And then the H model. Make sure on your paper, extremely important on your paper, that you show your work. So in your paper, put down all of your assumptions. What's really, I hate when I'm grading the papers is, because I actually plug in all your assumptions to see if I get your price, but students don't provide their assumptions, and I have no clue how they're getting the price. I'm trying to guess at their assumptions. And so make sure you're really, really clear on exact, what did you assume for long-term growth? What is your discount rate? What did you assume for short-term growth? What was your H? You might actually even put it in a formula into the paper itself so I can see, because some students have math errors. And I like to email them to say, hey, you're putting the parentheses in the wrong place. Make sure you don't do that on the final. So just so you know if you have a major issue. H model especially. Students do the H model and they get so they get like $82 on the dividend discount model and they get $3 on the H model. It's like, no, you did something radically wrong there. That doesn't make sense. And so I want to make sure they know that before they get to the final. So show me all your numbers. If you don't, I may have to email you back and say, I can't figure out what you did. Also make sure at the end of paper 4, you have a recommendation. So you have all these values that you think the stock is worth. I have some students write paper 4 and they never tell me what the current stock price is. That makes no sense in evaluation. Your whole purpose for doing this is to value the stock and compare it to the market price. So make sure you put the market price in there and then have a recommendation at the end. Right. Questions on, we might do these next Tuesday. We'll see with the holiday. I'd rather do it next Tuesday than extend into the next week because I want to focus on options there. I think you have everything you need to do papers 3 and 4. Has anyone tried starting on them yet? At least has anyone picked their company yet for 3 and 4? So you're kind of getting going. So I haven't looked to see how many people have viewed the video yet. So we'll see. All right. So we're going to change gears, and those that took my class last semester, you're going to have to watch this again, but it won't hurt you because you might have forgotten some of it. Do y'all remember any of this? Leo and Jacob? I can't remember who else was in there, but you remember talking about relative value analysis a little bit. So let's do it. Let's see if you remember. This will be a test, see how much you remember. All right, there's only one question on the final on relative value analysis, but it's probably the most missed question on the entire exam, and I don't know why. This may seem so just logical, makes perfect sense, but there's something I'm missing in the way I'm presenting it, that I'm losing something. Relative value analysis, everybody does it. except for college professors. But outside of academia, everybody does this. It's very, very common. It's the way most of us think about investing anyway. So let's look at it. We'll fit it into the common approaches to evaluation. We'll do a real estate example because most of y'all do relative value analysis when you do real estate anyway. And then we'll talk about what's got to be in a relative value analysis to make it work. So there's three ways to look at a stock or an asset. So we can do this if we're looking at small cap versus large cap versus non-US stocks. We can do this looking at Apple versus Google versus Alphabet. So whether you're looking at asset classes or securities, fundamental analysis, that's what you're doing in papers 3 and 4, fundamental analysis. You're figuring out what you think the stock is worth. Technical analysis, we don't do in this class at all. My security analysis class has to write one paper on technical analysis. That's looking at things like moving averages and breakouts, and it's charting. You're looking at the stock's price to try to figure out where it's going next. You're looking for trends. Technical analysis is often just completely ignored in undergraduate and colleges. And then what we're going to do is relative value analysis. You can do technical for asset classes and securities. You can do relative value for asset classes and securities. I use relative value all the time for asset classes. I was showing the investment society just last week, value versus growth, and looking at that relative value analysis. Where are these stocks relative to each other versus their histories? So colleges tend to put 99% of their effort on this first one, completely ignore this one, and they may give some lip service to the third one. Although I saw a student in a graduate course where they're doing a lot of relative value analysis. So it is out there, definitely. So what is relative value analysis? So you're taking some value of the asset security that includes what the market thinks, and you can compare it to some underlying factor that comes specifically from that asset class or from that asset or from that security. So what are those measures of value? There's only 2 of them for stocks, price and enterprise value. We'll have to talk about those 2. And then what's the fundamental factor? There's many of them, but they tend to be related to earnings, revenues, or book value. And there can be a lot of industry specific ones. So we're going to compare price to earnings, our enterprise value to earnings revenue. We're going to take this and divide it by that to try to see how much are we paying for earnings, how much are we paying for revenue, how much are we paying per book value. We're trying to figure out if one stock's more expensive than another stock, why is that? So we'll get into these definitions here, but let's kind of get the theory first. So relative value analysis generally is not trying to figure out if something's cheap or expensive in and of itself, but cheap or expensive relative to something else. You can use relative value analysis to figure out the stock market expensive to itself today, but it's always going to be based on history. So what we're looking at is something is cheap or rich, and those are the official words. I would not have used those words, but those are the words they use. Cheap implies inexpensive, or it's a really bad security. So cheap means, I think, inexpensive. Rich is a really bad term, I think. Rich is expensive or highly valued or whatever it is. So which of these would be a value stock, cheap or rich? Cheap, yeah, value stocks are cheap. And then what are rich stocks then? They're growth stocks, just by definition. Value stocks are cheap, growth stocks are rich. That's just part of this definition. So let's do the real estate example, just to get some, because you already do this. So let's just take the real estate example, then we can apply it to the stock market. So you're buying a house in a neighborhood. All you know about it is that they're asking $150,000. If that's all you knew, would you buy the house? Not enough information, is it? So then they say, okay, well, there's 2 other houses in this neighborhood. One's going for $875 and one's going from $675. Would you buy it now? Are you more likely to buy it now than you were before? That makes some sense. Doesn't tell you everything, but it certainly, you do know there's probably something wrong with this house, don't you? Because if it was worth $800,000, they'd probably be asking $800,000. So unless there's just some seller, I mean, it's pretty ridiculous, right? There's some sellers not paying attention. They're selling for 150. If that happens, they're gonna have a lot of people bidding on the house. So it's probably not gonna last. So there's obviously something wrong with this house. But still not enough information, because now you're really wondering what's wrong with this house. Is it in California on the side of a cliff and they've had mudslides? Is it in a flood zone? Is it a really, really old house surrounded by all these brand new houses? Who knows what? So now we're going to do a relative. So the price per square foot for this house is $75. Those other two houses are going for $250 and $225. Are you getting more interested each slide? So now what have we done? We've adjusted for the size of the house, and that's a price relative. Price per square foot is a price relative. So this house is definitely very, very cheap. If it was going for $250 per square foot, you know, it's just a really, really itty bitty house. But now we know it's a cheap house. So you only have to pay $75 per square foot. This could be Macy's. You're paying $75 for a dollar or whatever, a dollar of earnings or something. That'd be a high PE, but you're spending $75. But if you're buying Alphabet or Amazon, you'd have to pay $250 or $225 for that same thing. So it's a lot cheaper. The house is a lot cheaper. Why? Probably because it's not as high quality. It's got some problem with it. There's something going on, but it is a cheap house. We can say that it is a cheap house. May not be a good buy, but it is a cheap house. Everybody agree with that? Definitely a cheap house. These are expensive houses or rich houses, but they may be worth it because there's something really, really nice about them. So price to square foot is a price relative. It's a really easy way to compare buildings that are different sizes or companies that are different sizes if we're doing price relatives. So then we say, okay, well, let's try to figure out what's really going on with this house. So let's bring in everything we can think of. I brought in some things, but let's think everything you possibly think of. I found a website that actually does this, and I should have brought it to this class, but it's pretty interesting, where they're trying to do exactly this. Take all the houses in the United States and adjust for every single thing you can think of, build a regression model, and try to figure out what's going on. So houses in Austin are a lot more expensive than houses in San Antonio. Is there a reason for that? That's not on this list. Probably so. Supply and demand. There's not enough houses in Austin. And they're building houses in San Antonio, but they're still cheaper in San Antonio. So, you know, there could be unusual reasons I don't have captured here. I don't have location really here, but the size of the house we've already gotten with the square foot. Does it have a pool? How many bedrooms? How nice is the kitchen? What's the landscaping? Those kind of things. So this is related to value, and then we have things related to risk. That's going to be really, really important on stocks, value and risk. You got to have both of them. If you ignore risk, you might find a stock that you think is cheap, and it's not cheap. It's just really, really risky. You got a lot of debt. So if you don't adjust for risk, you end up overpaying. So we need something, because we adjust for all this and everything looks great, and then we discover it's in a floodplain and it's going to be destroyed in like 10 years, then probably not a good idea. Would you buy a house on the coast of Corpus Christi? What's likely to happen to the house in the next 50 years? Probably gonna get destroyed. Doesn't make sense to me that people buy houses on the coast. I would just save all the money and go stay in a 5-star hotel and travel down there, but some people do that. But that's not completely captured here, but I could. There are some places that are prone to catastrophes, earthquakes, and hurricanes and those kind of things, tornadoes. So you might put that in there, but anything related to risk. When we do that, I can explain 91% of the volatility in housing prices in this particular city or in the country or whatever. And so based on all of that, this house I can get for $75 per square foot should be trading for $150 per square foot. If my list is comprehensive, would you buy the house now without looking at it? You might be tempted now to do that. You might still want to look at it because you want to know if it's, got a nice floor plan or you like the brick or whatever. But if I capture all that back here, then we should have it there. So now we're a lot more tempted. And this is what we want to do with stocks. We take all those things we can think of and look at all these stocks and try to adjust for it. Then we say, hey, based on all the value we have on this stock, they should be trading for this price instead of trading for this price. That's what we're looking for. Let's say we add one more factor or two more factors. Has anyone been murdered in the house, and is the house considered haunted? When we do that, the stock we have, its value drops from $150 to $80. So we know something awful's happened in this house. What if you don't care about these two things? Well, then you're buying a house that's worth $150 per square foot and you get it for $80 per square foot. That sounds pretty good, unless you need to sell the house 2 years from now. Then you still have a problem, don't you? Because whoever you sell the house to might care about those two things. Right? That's important with stocks. This is kind of the Warren Buffett approach. Warren Buffett says, when I buy a company, I'm buying it for the long term. So he may not care that the stock market's focused on things like this because he doesn't care. He's going to hold it for the long run. He's getting a stock for $80 that's really worth $150. And the market's focused on these things, and who cares about that? They'll figure out in 5 years that's not important. But if he needs to sell it in a year or two, you got to care about these things because these may still be important to the market in 2 years. So your horizon matters. Wouldn't you love to find a house like this? You get a $70 discount just because something awful happened in the house. You're like, I don't really care. Doesn't matter to me. You might say, hey, if it's haunted, it's cool. I have really cool Halloween parties or whatever. It's like you're not worried about it. So that's your choice. And that's the same thing with stocks. We have noticed when we run our models in investment society, there's things the market's really focused on that we don't think is that important. We say, well, if they think that's important, we don't, we're going to buy the stock anyway. So you can certainly do that. All right. So that's relative value analysis. It doesn't ask if the housing market's expensive or cheap. It's just trying to figure out if a particular house is rich or cheap. So I was noticing my mom's house. I sold her house early this year. Zillow keeps sending me values and they keep coming down and down and down. They're down about $70,000 just in the last few weeks. It's amazing how fast housing prices are falling, at least in Austin. I was eager to sell the house because I was worried about housing prices, so I'm glad I did. But on a relative value basis, that's how I was trying to sell it. On a relative value, I wanted to get as much money as I could for it. So we're not worried. We're not asking if the market's overvalued, undervalued. We're just asking if this house is well priced given what the market is today. So you have to have a price relative that's appropriate to your industry. We'll talk about that. And then you have to make sure you adjust it for value factors, fundamentals, and risk factors. There's some things that may be generic to all industries, and there's some things that are very specific to certain industries. Gross margin applies to most industries, but doesn't apply to financials. Asset turnover applies to most industries, but doesn't apply to banks and insurance companies. So there are some that, banks and insurance companies, you essentially have to build your own model. You can't lump them in with a bunch of other stocks because you can't do those type of analysis. All right, so let's talk about it with stocks. So you have to have the appropriate relative, some fundamental value, and some measure of risk in your model. So essentially we're doing regression analysis. We have these independent variables, things like margin, turnover, return on equity. We have debt to equity, those kind of things. We're trying to use those to forecast the dependent variable, price earnings, EV, the revenues. A firm that has higher fundamental values should have a higher relative. A firm that has higher risk factors should have a lower relative. So let's try that. I hate hitting escape, but we're going to hit escape. Now the market was up a bunch earlier, and then it was down, and then it's kind of back up. Anybody? We were trying to figure out what happened right here. Someone was saying the bombing in Poland, but I don't think that would do it. But anyway, oil prices are up. Tech stocks are up a bunch. Treasury keeps rallying. Pretty good day for treasuries, right? But who knows why that's going on. But let's look at it. So Amazon. Would you guess Amazon's a cheap stock or a rich stock? Probably rich. It's trading for a PE of 92. Is that high or low? So the S&P 500's PE ratio right now is about 20. So you spend, for the average stock, you spend $20, get $1 earnings. Amazon, you have to spend $92 to get $1 earnings. So very, very, very expensive stock. Is it expensive because we expect it to do really well growth-wise, or is it expensive because it's a really low-risk company? What would you guess the market's telling you? High growth or low risk? Probably high growth. I don't think of Amazon as low risk. What about Macy's? Cheap or rich? How many of you have been flocking to Macy's the last few weeks? Is it doing well or is it struggling? Would you expect this to be a cheap stock or a rich stock? Should be cheap. Let's see how cheap it is. What was Amazon? 92. Macy's is $4. $4 for $1 earnings. If they can just hold their earnings steady, you'll get all your money back in 4 years. That sounds pretty good. What's the market saying about Macy's? It's done for. Where does Macy's put their stores? Mainly in malls. Y'all don't go to malls anymore. Who goes to malls in your family? Probably just your grandparents. And they probably don't buy anything. They just walk around in sneakers so they can get their thousand steps in the heating or air conditioning. So it's definitely struggling. Moderna. So Moderna. What do you think the market thinks of them? They obviously had their greatest year ever because of the pandemic. What are they going to have after this year? They were losing money until the pandemic. So they need a pandemic to do well. Do you think the market's excited about them? Is the market forecasting multiple pandemics going forward? So guess probably cheap or rich. What would you think? Probably very, very cheap stock. Yep, $6. A fraction. What about Walmart? High growth, low risk. High growth, have a high PE. Low risk, high PE. What would you think with Walmart? Isn't this a low risk company? So Walmart has a really high PE ratio, 29. That's higher than the market. That's probably because it's a very low risk company. So that makes some sense. What about Tesla? What would you say on Tesla? A lot cheaper now than it was, but that doesn't mean it's cheap. It's just cheaper. But what would you think? Rich? Not as rich as Amazon, but still pretty rich. What about Nvidia? Nvidia has come down a bunch. They were a $300-something stock. Now they're down to what, 160 or something. You would think, wow, that they're a lot cheaper, but they're still a pretty expensive stock at 45. So still pretty expensive. What about Facebook? Facebook's come down a bunch, but is Facebook rich or cheap? What do y'all think? Think cheap? They were really cheap. They got down below 9, but they're now at 11. So they're a lot cheaper than Walmart. They used to be a much higher. You know, if you look at them, they used to be a $400 stock, and now so they've come down just 75%. So they probably were a 25, 30, 40 PE stock not too long ago, but they've come down a bunch. So the market's telling you something, and that's the key with this analysis, is the market's telling you something that you might agree with or disagree with, and your investment strategy is trying to figure out, what is the market telling me? Do I agree with it or not? So you can make a decision. So Amazon is probably trading really high because the market's expecting high growth. I'm not sure I buy that argument because their retail operations are not doing very well at all. So if they were to split out AWS as a separate company, I think the retail side would just look disastrous. It would look really horrible, but the market still thinks they're going to do great. I think Walmart is an expensive stock because it's a low risk company that's done extremely well in the last two crises. They were one of a few stocks that had a positive return in 2008. So I think of Walmart as trading rich because of their low risk. So that's what you got to look at. This formula tells you everything. So a value of a stock is its dividend yield, the dividend divided by KE minus G. That's the dividend discount model you're going to use in paper 4. You can expand this out. So earnings per share times the payout, that's the dividend. Everybody agree with that? Earnings per share times what percentage you pay out your dividend. What is this right here? What is that called? CAPM minus growth. That's just a dividend discount model. What if we divide both sides by earnings? What do you get? PE ratio equals this. If I were you, I'd be carrying this in your wallet. It's probably one of the most important formulas. Extremely important formula. What is a PE ratio? It's the payout ratio divided by 4 things here. 2 of them are related to the overall stock market. 2 of them are related to the company specifically. So a PE ratio has a direct relationship to interest rates. If interest rates are high, PE ratios are low. So right now, PE ratios are pretty high, mainly because interest rates have been so low. They're starting to come down because interest rates are rising. But in the 1980s, when I went into college, PE ratios were extremely low because interest rates were extremely high. So interest rates are high, PE ratios are low, interest rates are low, PE ratios are high. The market risk premium, how worried is our stock investors? When they're really, really worried, the market risk premium's high, stock PE ratios would be low. When they're not worried, everybody's happy, PE ratios would be high. All right, so those are related to the stock market, not related to your stock. And then related to your stock is risk and growth. When a stock's risk is high, PE ratios will be low. When the stock's risk is low, low beta, like Walmart, low beta, that gives you a high PE ratio. And then fundamentals, growth, this one's a minus sign, so it's going to go in the same direction. All of these go in opposite directions. Higher interest rates, lower PE. Higher beta, lower PE. Higher market risk, lower PE. But here, since you're subtracting higher growth, gives you a higher PE ratio. Lower growth gives you a lower PE ratio. So Macy's is probably getting destroyed because it has a high beta because it's a consumer discretionary and has very low growth. So it has 2 things dragging it down pretty dramatically. Walmart probably only has 1 thing helping it, a high beta. I doubt the market's assuming Walmart's a high growth stock. And so because of that, their low beta gives them a very, very high PE ratio. All right, so really, really important if you understand that. And then the one number I ignored was payout. And according to the theory, you can ignore payout. Any guesses why we can, I don't know, Josh and Jacob can remember from our class. Why can you ignore payout? Any takers on that one? I give you a hint, the sustainable growth model. Anybody remember that? What did the sustainable growth model say? Sustainable growth, ROE times retention. So higher retention, higher growth, lower retention, lower growth. So if you have a high payout ratio, what does that imply? Low growth, doesn't it? If you pay out more, you grow more slowly. So financial theory says these 2 exactly offset each other. You don't get a higher PE ratio because you pay out more, because that's going to reduce your growth and you just end up in the same spot. So we can essentially ignore payout and look at these other factors. So really, really important formula. You can also do this with the other ratios like EV to sales and price to book. It's just a much more complicated formula. But I would remember this. There's a whole lot in this right here. And a lot of people look at PE ratios and they only think about growth. They forget these other 3 components, and you have to keep all of those in mind. Okay, so these are old numbers, but it's interesting. I think I did these like in August or something. I don't remember when I updated these. It may be, I may have pulled the wrong file, but anyway, Tesla used to be 1,000 PE. You can see now they're down to what, 60 or whatever it was. Kroger's low PE ratio. Why is that? Is it low beta or, I mean, high beta or low growth? Low growth, right? Because they should have a low beta. They should have a high PE because they're low beta. You agree with that, right? This is a grocery store, but they actually have a really, really low PE ratio. Now they do have a lot of debt, which pushes their beta up some, but it's probably low growth. We'd already talked about Walmart and Amazon. So is Kroger cheap? Yeah, they are cheap. Are they slow growth? Is that why they're so low? Are they high risk? Probably not. Although they have the high debt, that still probably doesn't push them. Is Tesla rich? Yeah, definitely. Are they high growth? Yeah, absolutely. Their earnings are growing really fast. Are they low risk? No, Tesla would not be low risk. So Tesla is expensive because the market is expecting extremely high growth, except for now it's come down. Now, why did their PE ratio come down? It's because the stock price fell or because earnings went up? And the answer is yes. Yes, that is the reason why. Stock price came down and the earnings went up. So now their PE ratio is much lower. All right, so the key on the exam is understand when do you use which ones. When do you use price? When do you use enterprise value? And then which denominators? We'll do a team question practice probably the last week of class. So hopefully we'll get more students doing well in this question. I think it's pretty obvious, but some students, for some reason, I think it's exam anxiety or something. When to use price? Use price anytime you're comparing it to a number that is after interest expense. If you're looking at a number after interest expense, price is only stockholders. After interest expense is only the stockholders. Then you use price to that number. So a good example is earnings per share. Earnings per share is net of interest expense. So price to earnings per share is a good ratio. Book value of the firm. The book value of the firm is net of interest expense. It's assets minus liabilities, and it takes all the interest expense out. So you use price to book. You would never do EV, enterprise value, to book value. You would never do enterprise value to earnings per share. When to use enterprise value? Well, enterprise value is the value of the stockholders plus the debt of the firm. So it's everything, stocks and bonds. When you use enterprise value? Well, when you're comparing it to a number that's before interest expense. What does EBIT stand for? For interest and taxes. So is it before interest or after? It says it right in the label, before interest expense. EBIT, same thing, EBITDA, earnings before interest, taxes, depreciation, amortization. So enterprise value to EBIT makes sense. Enterprise value to EBITDA makes sense. Enterprise value to earnings per share does not make sense. Enterprise value to book value does not make sense because book value is net of interest expense. So that's what you got to do. Make sure you line those up. Revenue, where does revenue come on the income statement? Before interest expense or after? Is revenue net of interest expense or not? When you look at the revenue line on the income statement, did they subtract interest expense out of that? Absolutely not. So revenue is before interest expense. So what would you use for revenue? Price or enterprise value? Enterprise value. Anytime it's before interest expense. So enterprise value to EBIT, EBITDA, and revenue, price, earnings per share, and book value. Right? A lot of students still miss that. I'm not sure why. Y'all gonna have to tell me when we do the practice. Price to EBIT, nope. Price to earnings. Enterprise value to EBIT, enterprise value to EBITDA, enterprise value to revenue, price to book value. Now, if you go to Yahoo Finance, they did mess up. They have price to earnings, that's good. They have price to book, that's good. They have enterprise value to revenues, that's good. They have enterprise value to EBITDA, that's good. Where's the one place they messed up? Which one, if I give you an exam, you got to say that's wrong? Anybody see it? PE's fine. PE's fine. PEG ratio's fine. Price to sales, is that one okay? Sales is before or after interest expense? It's before, so they should be using what? Should be enterprise value. So that ratio is absolutely wrong. I don't know why it's there. If you use that ratio to find stocks, you'll say, wow, this stock's really cheap. It might not be cheap at all. It may just, the firm just may have a whole lot of debt. Because you didn't add the debt back in, the stock looks cheap. When you add all that debt back in, they don't look so cheap anymore because you have a much bigger number in the numerator. So that's, I don't know why they put that there, but someone messed up at Yahoo Finance. Probably the only mistake they've ever made. Questions on that? Because there's something I'm not doing while explaining this from prior exams. I can't tell from your expressions if you understand it or not. So what I do on the exam is I give you a company, like we had Best Buy and Dollar General. I give you a bunch of these ratios. Some of them are just wrong, like price to sales. You just got to tell me, kick that one out because you don't use price to sales and WISE. So someone just kick out, doesn't make sense. And then some of them work, but they're not good for that industry. So that's the next thing we got to do. When do you use which one for which industry? All right, we just talked about that one. All right. So you have earnings base, book value base, and revenue base. Earnings base, price to earnings, EV to EBIT, EV to EBITDA, PEG ratio. We talked about the PEG ratio for paper 4. It's the PE ratio divided by expected growth, the forward PE ratio. You can do price to CFO. CFO is net of interest expense. So you can do price to CFO. If you were doing a real estate company, you would probably do price to FFO, funds from operations. Just every industry has their own thing. Book value base is just price to book value, or a really popular one that I like a lot is price like 10 years of earnings per share. That one works really, really well, especially right now when we have all these firms with negative net worth because they bought so much of their stock back. You can't do price to book value, but you could do price to 10 years worth of earnings, and that would be a good relative to do. And then revenue base, obviously there's only one, EV to sales. So when do you use which of these for which industry? So here it is. You have to know this on the exam. Again, I think it's pretty obvious, but I've been doing this for 30 years, so maybe it just seems obvious to me. Earnings base, you can use for everybody. Everybody can use a price to earnings. But we tend to use earnings base specifically for high growth industries like technology. Technology almost always uses EV to EBITDA. It's the most popular one. It's just real common. We don't like to use price to book for technology stocks because they don't have a lot of equipment and furniture and buildings. They tend, most of their value is stuff they're going to do in the future that's not on their balance sheet anywhere. So earnings base, it really works for technology. Let's jump down to revenue base. Revenue base is real simple. Any industry that's really focused on margin. So all those retail stocks, we use revenue base. For Macy's, we would use EV the revenues. For Walmart, EV the revenues. Best Buy, EV the revenues. Dollar General, EV the revenues. It's just it's just pretty obvious you're going to do that. Kroger's, same way. The book value base, it kind of depends. So firms that have really high capital requirements, utilities, manufacturing, they have a lot of property, plant, and equipment, and Intel. You may say Intel, you'd be up here in technology, but Intel does have a huge property, plant, and equipment. Price to book makes a lot of sense for those industries. Cyclical, commodity-based companies like energy and materials, we like to use price to book there because their earnings are so volatile. A firm like Exxon looks really cheap right now because their earnings are so high. And they looked really expensive a couple of years ago because their earnings were so low. So we don't like to use earnings because you get kind of whipsawed. So we like to use price to book. Steel companies, those kind of companies are really sensitive to commodity prices. And then industries focus really heavily on return on invested capital. Banks and insurance companies, we almost always use price to book. It's just the norm. I'm surprised USA sold their investment company before they sold their bank, because they really need to sell their bank. I'll put that on recording just in case Wayne hears it. They need to sell their bank. How would they sell their bank? They would look at the net worth of USA's bank, look at a typical price to book value out there, and they would decide on that. So if USA were selling their bank, probably the closest bank to them, maybe Capital One. So Capital One's price to book is 0.66. Trading below 1. Banks traditionally have traded above 2, but they're trading below 1 pretty cheap. So if their bank's net worth was $500 million, they take 0.7 times that, and that's what they think it's sell their bank for. Now that's at the low end. They might look at Frost. Frost has a price to book of 2.65. So USA might say, hey, look, Frost, they're just down the street from us. We're going to sell our bank 2.65 times. Is there a difference between 0.6 and 2.65? Yes, several hundred millions of dollars. So USA may argue, hey, 2.65 makes more sense. Oh, we're out of time. Sorry. This is a 2-year bond. Everybody agree with that? You don't care that was issued 8 years ago. What's it rated? BBB. What's its coupon? 0.04 times 1,000 divided by 2. So you can get $20 every 6 months. What's our KD? The risk-free rate. This is spread. So it's a 2-year bond. So 0.006. Remember, convert everything into decimals. Don't use percents. Plus our spread. 2 years, BBB, 92 pips. Plus 0.0152. Is that what y'all got? 152. Does that sound familiar? And then the effective is going to equal 1 plus 0.0152 divided by 2 raised to 2 minus 1. So it's probably 152 because it's such a low rate. $1,526. We'll do one. All right, so there's the basics of it. See, we need 4 columns and 3 rows, I think. We'll see. So time. Oh, we need 5 columns. So 0.5, 1, 1.5, and 2. You have your cash flow. Pretty straightforward. 20, 20, 20, 1,000, 20. Your discount factor, 1 divided by 1 plus 1.0526 raised to the 0.5 raised to the 1 raised to the 1.5 raised to the 2. And then you have your DCF, so you just do that. A lot easier to do it in Excel. Did I do 1 divided by? I don't think I did. Yeah, I did. Great. And you just multiply across. What did y'all get? Saw some 1,076. Does that sound right? Oh, I made a mistake somewhere. Where did I make a mistake? Ah. There's a mistake. I left out a number. Okay. How did I know that was wrong? The coupon was 4%. My discount rate was 1.5%. So I knew it was wrong because it had to be a premium bond. Any of y'all get 1048? Does that look familiar? Let's double check it. So 20 divided by 0.0152 divided by 2. There's infinite cash flows. We take $1,000 minus that. Bill Gates, what do you have? Times or divided by plus 0.0152 divided by 2 raised to the 4. Does that look close? Looks pretty close. It's off because I rounded to 6, but I think that's the right answer. Any of y'all get 48? That sound familiar? So sounds like you did. All right, 1,048. I'm not going to put it in here, but I'll just put the answer in 1,048.67. So it's a good exercise because you better know it. This is one of those things every finance major knows. So it's just pretty basic. All right. One thing, I don't know if y'all noticed, so you did paper 2. Have y'all been watching earnings reports? They're been pretty phenomenal. Walmart just killed and then Target missed. That's pretty interesting, isn't it? And then today, I think Macy's today had good news for a change. It's pretty rare for Macy's to have good news. I don't know if their stock's up. Looks like it's up a little bit. So they reported good news. So it's really strange, isn't it? Target misses, Walmart hits, and Macy's. You would think Macy's would hit, miss, and everybody's going to Target and Walmart. But what they're discovering, at least by this article, is Nordstrom and Macy customers are still spending there. Target customers are moving to Walmart. So there's this group in the middle that are hurting, but the wealthy are still doing well. So they're still wasting money at Nordstrom's, but the middle class is moving down to Walmart. At least that's what they're thinking here. So profit margins 3.9% versus 5%. That's pretty serious. Gross profits reduced. Comparable sales. Sales actually did okay. Inventory increase. Inventory has been a big issue for them. EPS, here's the big one though. EPS, $1.54 versus $2.17. That's a pretty huge miss for them. What was interesting on this day, is that while Target's price was down a bunch, you can really see it, can't you? Walmart's stock price on that same day was up like 5%. Really strange. I bet if you went back historically, you would find very few days where Target's down 10% and Walmart's up 5%. You can go back historically and see, but I doubt it's happened very often in the past. And then Macy's, it's been all over the place, but that's a pretty good jump for them. Still a very low PE ratio though. So keep watching earnings. I don't know what earnings is coming out today, but we've had some pretty interesting one. I probably would have given you Target as one of the companies if we had it available, because it would have been an interesting story. So there's something strange going on. It may be that Target just made some mistakes, bought too much inventory or something, and that Walmart and Macy's didn't do. Who knows? We can see if JWN jumped up today, and it didn't jump as much, but it is up. So unlike Walmart and Target, Nordstrom's and Macy's moved essentially in the same direction. So stock market tells you a lot about what's going on and what people are thinking. All right. So today we'll talk real quick on portfolio management. I'm really eager to get into derivatives. It's one of my favorite topics. So just real quickly on portfolio management. Some of y'all sat through my wealth management class that I still need to develop a little better, but just what does it mean to set up a portfolio? So if you're going to set up your portfolio, you're going to have a 401k plan, you're going to have a brokerage account, you're going to set up a Roth IRA. You buy individual securities or you buy mutual funds. We're on stocks. Once you get to about $100,000, you can start buying individual stocks. If you're investing $3,000, you're going to have a tough time buying individual stocks. So you're probably going to have to do mutual funds. Bonds, you just always do mutual funds. And once you get to about $50 to $100 million, you could buy individual bonds, but even then, it's not really worth it. There's a friend of mine that he has like 50 to 70 million, and USAA actually set up a separate account for him where they bought individual bonds, but I don't think it got him that much to do that. It doesn't help much. USAA was buying bonds in $200, $300 million blocks. So that's what you're competing against. And bonds are very illiquid, so your bid ask is going to be massive. So it just doesn't make sense. I know a lot of small investors buy municipal bonds, but I think you're really throwing a lot of money away. The best story I heard on that is USAA sold a municipal bond, and it's when the markets were down, so they sold it for 92, and they watched that the guy who bought it from them turn around and sold it at 100 to his small clients. So he made almost 9-10% in one day by ripping off his customers. And USAA people were like irate. It's like that bond was not worth 100. But his customers didn't know, so he ripped them off. So you got to be real careful, bonds. So what is a good company? What's a good stock? So we somewhat talked about that. Good companies have good fundamentals, are growing fast, but they could be really expensive. So you're trying to find a good company that's trading a little bit cheap. I talked about an investment society last week. Find some value stocks. They're cheap stocks, but have really good numbers. There are obviously not going to be a lot of those, but if you can find those, that may be the way to go. So what do you need to build a portfolio? So you need 4 things: a philosophy, a screening mechanism, a process, a construction philosophy, and then your risk management. So your philosophy starts with the words, I believe. I believe stocks with these characteristics will beat the market. Or your I believe might be, I'm just going to buy the market and buy index funds, and then your workload just dropped 97%. So you're going to look at fundamentals. How fast are they growing? What kind of returns do they have? Look at quality. What's their credit ratings? How much do you have to rely on accruals? Management is one thing. If I'm going to buy stocks, I'm going to definitely look really carefully at management. One thing I always do if I'm going to buy a stock is I'll go to YouTube, put the CEO's name in, and I want to hear that CEO getting interviewed or presenting at a conference. That's just, to me, it's extremely important. Then valuation, doing exactly what we're going to do next Tuesday for our team competition, which is the stock valuation. Do a stock valuation and see if the stock's cheap or rich. Some people use technicals, momentum, those type of things, try to figure out. It might not be which stocks to buy, but it might be when to buy them. If you're looking for an opportunity, we're not going to do any technicals in here. There are thematic investors that they may look at some trend or something going on and they think, wow, I think that's going to keep going. The biggest thematic that came out during my years was the baby boom. Just watch the baby boomers, because those are the markets that are going to do well. So in the 60s, you bought baby food. And in the 70s, you bought real estate because they're all getting their first house. Then you see the stock market take off in the 90s because they're all investing for retirement. And now we're going to see them divest. And so that was one thematic type of investing. If you have a philosophy, you might back test this to see if it worked. Back testing is really, really hard to do. I've tried it several times, but it's just tough. There's not really good databases. And one reason is you might have a philosophy you think is really good to buy value stocks. And you go back and look at it historically, it does great. But your problem is if your database is Bloomberg or Yahoo Finance, if you went back and bought a firm 10 years ago and went out of business, that's not in the database anymore. So all your biggest mistakes won't be in the data. And so you're going to overstate how well you did. Because if you bought a firm and went out of business, you want to have that in your analysis and it won't be there. So if you're buying value stocks, more of them go out of business than growth stocks. So you might say, wow, this value strategy works really well. Well, it really didn't work all that well. So back testing is really difficult to do. But you should at least try it and just see. We did that a lot at UTSA. It's always number crunching difficult. So you have your philosophy, now you have your process. The Investment Society shows you how to do this. We've been doing it all semester. Every team has finished. They've got a model and they got a buy list. So they screen stocks down to a buy list of like 20 stocks. And now this next semester in the spring, we're going to try to get the 20 down to 2 or 3 that we're going to actually buy. So if you want to learn how to do that, you can teach yourself watching YouTube channels or join an Investment Society team. The next thing is construction. So on process, you're starting with a universe of 3,000 stocks. You're trying to get down to your final list of 50, 100, 150 stocks. There's some portfolios that are really concentrated. They only buy 10 stocks. There's some that are very diverse. But even if you're going to have 150 stocks, how are you going to put them in there? You're going to put one 150th in each stock. You can have models that say overweight this, underweight this. You have to figure that out. Equal weight's the easiest. So you might just say, hey, I'm going to buy 100 stocks. I'm going to put 1% in each stock. Then your question is, when do you rebalance? Because you put 1% in every stock, tomorrow they're not going to all be 1%. Some are going to be up, some are going to be down. So the most common rebalances is once a quarter. Some professor did a massive study and he said once a quarter makes the most sense. You can do fundamental weighting, and I recommend you go out and read some Robert Arnott articles. Actually, you can probably put Robert Arnott and Cliff Asness, because they've been debating this forever and ever and ever on fundamental weighting. They've been doing this forever. Cliff Asness is at AQR Capital. Fundamental indexation, there's Robert Arnott. So this is the big thing, gotten really popular. I don't know how well it's doing, if they're actually having success with this strategy or not. But Robert Arnott, very highly respected. So there's his paper. But then Cliff Asness, the two of them are highly respect each other, but they've been having this public debate. Cliff Asness says, well, you're not really doing fundamental indexing. So fundamental indexing, what that means is you're going to weight the stock based on some fundamental value, maybe revenues, maybe net income, some accounting back value. If you market weight, your weights are how big the stock is in the market. So Apple's going to get most of your weight because it's the biggest stock. Fundamental weighting says, no, forget about the market cap. Look at something else. Total assets, total revenue, something like that. That's called fundamental weighting. So what Cliff Asness says is, you look historically, fundamental indexing works really well, but that's not because you've come up with some secret. That's just another way of buying value stocks. If you remember what a value stock is, it's cheap. So its price to earnings is lower than growth stocks. So if you weight by earnings, then obviously you're going to have more value stocks than growth stocks. So that's what Cliff Asness said. You're just doing value investing. And Robert Arnott, very smart person, he says, yeah, you're right. That's true. But it still works better. So there's some debate on that. But there may even be a YouTube of these two debating, which would be really cool. They're both really brilliant people, and they're both really good presenters. So you might Google some of that. To give you something really interesting to talk about in an interview, if you're doing a wealth management interview or an investment interview, that would be a good topic to bring up. I think Victory Capital started a fundamental weighted mutual fund here not too long ago. Some people call this, you might try this approach. Some people call it smart beta. Have you heard that term before? What smart beta means? Here it is. Here's Arnott himself. Oh man, he's he's starting to gray a little bit here. So there he is. Great guy. I really have a great deal of respect for him.
We recently released a paper entitled Forecasting Smart Data in History.
So those are great sites. So Robert Arnott, I would go Google on YouTube, Arnott and Asness, and just listen to every single thing they have. I've never heard him present where it wasn't just like everybody wasn't just blown away. He always brings in really interesting stuff. He's the one that came up with the research. What country should you invest in? You should find the country whose productivity is going to grow the fastest. And that's why he said you find countries with young people, because young people aren't as productive as older people, but their change of productivity is much higher. And he went through the entire world and looked for that. Just brilliant guy. So I love this quote here. Why history is worse than uses in forecasting the alpha of smart beta strategies. So it's an interesting discussion, but definitely highly recommend. It really will give you an edge in interviews because he's talking about the stuff that people you're interviewing with are talking about. The stuff in your textbooks is what people were talking about 20 years ago, but the stuff he's talking about is what people are talking about today. So it just gives you a huge edge. You could have it based on models. You could have scoring models or kind of thing. I remember JP Morgan, they have a few hundred analysts. So they just took all of their ratings and you put them in quintiles, top quintile, second, third, fourth, fifth. And so they weighted them based on what quintile you were in. That can work. Very, very mathematical. You might have some kind of optimization model. So some of the quant investors, they have really, really massive spreadsheets that try to figure out how much. And what they do is they figure out, I want this stock, I want 1% of it, but I got to worry about trading costs. So their models actually figure out what's the best trade to do given the trading cost. All right, so you have your philosophy, your process, how you're going to construct a portfolio, and then your risk management is what is your sell discipline? When do you know you're going to sell a stock? And you want to be really precise on that. Some people say, hey, if I bought a stock and it falls 10%, I must have messed up, so let me just sell and get out. So that could be one approach. What most people do is they have a target price and they say, once my stock hits my target price, I'm selling. So that's one approach. I'll talk about how you can do that with options in a much more intelligent way. The problem I have with if it falls 10% is if the entire market's falling 10%, then it doesn't tell you much. So I'm more of, if it's a consumer staple stock and it falls 15%, but consumer staple stocks are up 5%, I must have made a mistake. But if my consumer staple stock sounds 15 and consumer stocks are down 20, then maybe I did okay. So I tend to do it relative to the industry. But these are the kind of decisions you got to make. So you start trying things. There's plenty of places you can go. We tried setting up Thinkorswim. I don't know if y'all got it to work any better. It's still loaded on my machine in the FSC. So I should go out there this summer and play around with it some, just to see what I found it to be a really complicated site compared to what I was using with Schwab. But you should make sure you have some brokerage account set up somewhere, even if it's all paper trades, so you have something to talk about. How many of you are doing portfolio management? You may have a portfolio here. You have it. Stocks, individual stocks, are doing ETFs or stocks and options. Options, yeah, options are great. You had to set up a special contract to do the options, and you had to get approval to do that. And then I had that problem with my mom's. I want to do options on my mom's account. So I filled out the application as if I were my mom. So I said, Mom, you now have a lot of experience in investing. He said, okay, whatever. But yeah, I want to be able to do options with, they're fighting back on me on that. Okay, derivatives. Let's talk derivatives. Love this topic. So I got USAA in the derivatives in a big way. I'm not sure if they're still using them or not, but boy, I just, especially in 2007, 2008, even 2005, I love them because the nice thing with the derivative is they're very, very, very levered, which means a small investment gets you a lot of stuff. Some of these investments you can invest. I might show you GameStop. If you had bought GameStop call options at the right time, you could have taken $1,000 and become a very, very wealthy millionaire. in just a few weeks. They're very, very levered. That makes them very risky, but it also means they can reduce risk, because if you buy them as a hedge, a little bit can save you a lot of money. It's a lot like your auto insurance or your homeowner's insurance. You're paying $100 premium, but if your house burns down, they're going to pay you $300,000. That's a pretty good return on your money. Or life insurance, you pay $50 for life insurance, and the person passes away, they get $500,000. Very, very, very levered type of investments. That's what a derivative is. So the technical issue for a derivative is it derives its value from something else. So, you're going to buy Apple stock or Walmart stock, you're going to value those companies, look at their cash flows, but you don't value a derivative by looking at its cash flow. You look at it, value it by looking at what it's based on. So it derives its value from something else. What is that something else? It's called the underlying. See if you can work the word underlying into your discussion in an interview. That would be pretty impressive. Nice thing is there's only two derivatives. Futures and options, and that's it. There's no others. Every derivative falls in those two categories.
You don't consider spots? Spots.
Swaps are futures.
No, spots.
Spot.
It's spot trading.
Oh, spots. Well, spots is the cash market. So, I mean, derivatives are based on the future price. The spot is the day's market. So the spot oil price is what you can buy oil for today. The futures price is what you're promising to pay in 3 months. So yeah, everything is either an option or a future in the derivatives market. An option, just like it sounds, gives you the option to do something, but you don't have to. A future, you're obligated. If you enter a future, you're obligated to do something. If an option, you enter an option, you don't like what you did, you can just let it expire worthless and you're out. But a future, if you enter a future and you don't like what you did, you're gonna lose money. A lot of money sometimes. So how big are these markets? So it's pretty shocking. I love this website. I think I gave it to you in the notes. So I don't know who came up with this site. I don't know how often it's updated. Yeah, this is kind of old, but it's probably hasn't changed too dramatically. All right. So silver, there's about $43 billion in silver in the world. Cryptocurrency, this needs to be updated, but 244 billion. Military spending, US budget deficit, 3.8 trillion. Coins and banknotes, 6.6 trillion. The Fed's balance sheet, this should be updated, but through 2020, 7 trillion. Billionaires, you add up all their money, that's 8 trillion. Gold, 10.9 trillion. The S&P, or the Fortune 500 companies, that's where's the number? They don't give me the number, but whatever that number is on that particular day. All stock markets together, 89 trillion. The money supply, that changes a lot, 96 trillion. Global debt, all debt. There's more debt than stocks. A lot of people don't realize that when you add in all the debt in the world, especially even public debt, treasuries, corporates, it's a bigger number, 253 trillion. And it's massive. Real estate is bigger than debt, $280 trillion. You can see the boxes get a lot bigger. Commercial is 33 trillion, agriculture 27 trillion, global wealth $360 trillion. So that's got to be the biggest number here, right? If you think all the wealth in the world, that's $360 trillion. Can we get a bigger number than that? Well, we can, because you can see I still got a long ways to go. There's total wealth by country. Oh, derivatives, 558 trillion. That's a notional amount. How can derivatives be larger than the entire wealth of the entire world? Do we have like Martians buying our derivatives? What's going on here? It's kind of strange, isn't it? So massive. I mean, you can almost not even, that's where most of the page is. I don't know if they break this out between the red and the purple, but that's notional amounts. So it's a little deceptive, but it's a massive, massive, massive number. So derivatives are the biggest part of the market. So the entire wealth of the world is about 1/3 the value of all derivatives in notional amounts. So cool website, website. I wish they would update it here. All right, let me get rid of this thing again. Do you think if I emailed Zoom, they would change that button? All right, so what is notional amount and why is it so massive? Well, notional is what you're committing to, but it is not the market value of the derivative. So let's say you do $1 million in oil futures, which means you're going to buy $1 million of oil in 3 months. The notional amount is $1 million, but when you enter that contract, the market value is 0. So you put it in the books at 0. The accountants struggle. When I did the first few derivatives, like, what entry do we make? It's worth nothing. It's 0. The first swap I did. How do you enter a swap on the balance sheet when its value is 0? Now, the next day it might be worth $10 million, but the day I did the transaction, it was worth 0 because that's the way futures are. But the contract itself was on $3 billion. So you got the notional amount's $3 billion, but it cost me 0. And that's what the notional amount is telling you. It's an exaggerated number. The news media loves notional amount because it's such a massive number. They love talking about it because it's such a big number, but it's a little bit fictitious. But if you buy $100 million of S&P 500 futures, you got $1 million. You got $1 million of notional amount, but the market value that's going to change as if you had $1 million in the S&P 500, but you actually don't have $1 million. So if you put $1 million in futures and the S&P goes up 10%, then that future is now going to be worth $100,000. Right? So it's a kind of a strange number, but notional amount's really important because it tells you your risk. That's where you can get really in a lot of trouble. If you do a futures and you thought you did 10 million, but you did 100 million, the market value is 0 either way. You enter it at 0. So you might be a little shocked when the market moves because your exposure is to 100 million, not to 10 million. So you got to be really, really careful. What are underlyings? It can be a stock. It can be an ETF. It can be an index. It can be a commodity like oil or gold. It can be an interest rates. That's what I did my first swaps on, were in interest rates. Inflation swaps are not all that popular, but they are out there. Currency is probably the biggest one. People manage their currency risk using derivatives. There are even derivatives on weather. Have you ever heard of these things? So let's say Disney is worried about a heavy rain season because if it rains a lot, they're done. And a farmer is worried about a drought. So Disney wants someone to pay money if it rains too much. That's their hedge. A farmer wants someone to pay them money if there's a drought. So Disney and a farmer enter a contract and they look at how many inches of rain there are. And let's say the base is, I don't know, 10 inches. If it rains 20 inches, the farmer has to pay Disney. If it rains 2 inches, Disney has to pay the farmer. Disney's fine with doing that because if it only rains 2 inches, they're going to have their theme park open a lot more days and they'll make a lot more money. If it rains a lot, the farmer's fine with that because they're going to make a lot more money and they'll pay Disney. So that's a weather derivative, kind of bizarre animal. Catastrophes, UTSA was the first company to create a catastrophe bond. So if you go back to the history of catastrophe bonds, UTSA will be there. I remember the guy who did it at UTSA, really, really smart guy. They developed it with some investment bank. But yeah, UTSA created a derivative based on how big hurricanes are. The hurricane's small. If somebody might take my P&C class next semester, if you do, we're going to actually do cat bonds in there. I'll show you how they actually work. There's life insurance derivatives, social impact bonds. Those are pretty cool. Someone comes in and say, hey, if you hire us to run your prisons, your readmission rate will drop 70%. And so the city says, hey, you know what? We're going to borrow against that. And if they're right, and we save all that money, we'll pay our bondholders 7%. If they're wrong and we don't get those improvements, we're only going to pay our bondholders 3%. So the bondholders looking to say, well, I think this program is pretty good. we'll make 7% if it works. The city's thinking, hey, if it works, we're going to save all this money so we can afford to pay 7%. If it doesn't work, then at least we're not paying 7%. Pretty cool. I mean, I don't know where they've gone. It'd be interesting. I'm always want to stop class and just start researching social impact bonds. Let's see what they've come up with here. Yeah, I bet there's a lot of green social impact green bonds out there related to carbon. So you have green bonds, social bonds. Yeah, they're just all over the place. So there's another topic you could bring up in an interview and they would be like, how do you know about that? So we gotten pretty creative. There's a great book, and I wish I could find the name of it. I highly recommend you read it, but I can't remember what it was. But it was a person who'd worked on some of these exchanges, and his job was to create new derivatives. And he goes through how they could create a new derivative. It was really a fascinating book. When does the derivative work? When it doesn't work? He gave some examples of derivatives they thought were going to work really well. They just didn't go anywhere. And some that were really popular, he was kind of surprised in. Really, really good book, but I can't remember what it was. One of these days I'll find it and put it on my reading list, but fascinating. But essentially what he said is for a derivative to work, you need to have a hedger on both sides. You can't have a hedger on one side. So it worked out with the rain because Disney wins if it doesn't rain, the farmer wins if it does rain. So both of them have something to hedge. If one side's a hedger and the other side's the speculator, it doesn't really work very, very well. And that was his main thing. You got to buy two sides. So that's one reason inflation hedges haven't worked too well. There's a lot of people worried about inflation rising. There aren't as many people worried about inflation falling. So it's hard to find the opposite side of that. So current inflation hedges just have not worked very well. There's a lot of resources you can get into. Khan Academy has, I watched some of his videos. They're pretty good. My students have really pushed this book, Options as a Strategic Asset. I have not read it, so I don't know if it's any good. I did read this book. I thought it was really, really good. Trading Corporate Earnings News. Really, really interesting book. Very short book. But you know, when a firm like Target reports earnings, their stock can be much more volatile. So you know, if you do a trade where you get paid for volatility, having it around earnings announcement date is a really good way to benefit from that. But you also know the market already knows that, so it's already priced in. So what they're talking about is how can you trade options around earnings announcement dates in a way that you can make money off of it. A really fascinating book. It covers more. They do straddles. We'll talk about straddles. They do straddles because straddles is what you want. A straddle is a strategy that works really well if something moves a lot. You don't care if it falls 10% or goes up 10%. Either way, you make money. You only lose money if nothing moves. So it would have been, I should set up a straddle with Target and see if it would have worked. So it's a really good book. I do recommend it. It's an easy read. They don't get all the technical. The options guide is actually a pretty good website. Walks through strategies. We'll probably see someone. If I spelled it correctly. What are stock options? Recovery calls, we're going to do those. Straddles, we'll cover them. So it's got some good stuff in it. I really like the CBO even more. They obviously want you to do options because it's the Chicago Board of Option Exchange. They have some great resources. Look right there, education. So they have videos you can watch. They got their option calculator, which we might look at some in here. There's just a lot of free stuff they have here. So it's a good site. So there's plenty of places to go. If you want to teach yourself this stuff, you certainly can. We have some alums, one in particular. Eric is up in Chicago working in option trading. I saw him this summer. I went up to Chicago and had dinner with him. Well, he's way over my head now. He's been out there 5 years and he does nothing but this all day long. And it's just pretty amazing. I wish I could get him to come talk I got him to talk to one class a couple of semesters ago just by Zoom. Smart guy. But yeah, you can get extremely deep into this stuff. So you just know it in a way you can't even talk to anybody else about it. It just gets so complex. Here's some podcasts that you can listen to on options. So there's a lot of stuff you can do. There's plenty of YouTubes, I'm sure, as well, that you can do, but you can definitely teach yourself. We're going to do futures pretty quickly. Check the time, sorry. We'll do futures fairly quickly, and then we'll spend a lot more time on options. If you take my risk class, we spend a lot more time in my risk class. I go through a whole scenario on swaps, which I'm hoping I can keep doing for many more semesters. They're thinking about changing that class somewhat. So, but I really like how to use a swap to manage risk. So we won't get into that. Futures and swaps are essentially the same asset. So we'll talk about futures and then get much more into options. So if you do a futures, you're getting into something where you're signing up. You've got to do it. So it obligates you to buy an asset in the future or to sell an asset in the future. So if you're long the future, you're bullish on the asset. So that means you win if the price goes up. If you're short a future, you're bearish on the asset. And be real careful because people get real confused on this. If you buy interest rate futures, you win when interest rates fall because it's the price of the bond, it's not interest rates. So don't think I'm doing interest rates. I'm going to go long interest rate futures because I think rates are going to rise. That's not how you do it. Think of it in bond prices. So interest rates fall, you want to be long interest rate futures. So it's bearish on the underlying asset. So if you're going to think the S&P is going up, you would buy S&P 500 futures. So I'll give you an example with oil. Well, I'm not that far off the spot price with this example, but when I did this class in 2020, I was way off. But $100, the futures price is 102. So you have a choice. You can buy oil today at $100, or you can enter a future today, and you can buy oil for $102 in 3 months. What's the disadvantage about buying oil today? Well, it's cheaper. You get it for $2 cheaper. What do you got to do for the next 3 months if you buy oil today? What are your neighbors going to think when 100 barrels of oil show up in your front yard? They're probably going to ask you to go store it somewhere. That's going to cost you money. You know, maybe you can go to one of those, those storage places and go, yeah, I need a lot of space. That's going to cost you a fortune. The other thing is if you buy it all today, you're out the money. So you got time value money. So you got two costs. You got the storage costs and you got the time value money. If you buy the future, you don't have any of that. If you don't need oil for 3 months, then don't buy it today, buy it 3 months. But if you buy it in 3 months, it's going to cost you $2 extra. So that's your choice. And those two should be in balance so that the storage and the time value money is called cost of carry. So if it costs you $1.50 to store the oil and you're losing 50 cents in interest, if you buy the oil today, it's going to cost you $2. Or you can buy it 3 months from now, it costs you 102. You're indifferent. Either is the same for you. So the spot price is what you can buy for today. The future price is what you're obligated. So that's cost of carry, it's storage, and time value money. So you have to decide, if you can store oil a lot cheaper, or if your cost of capital is a lot cheaper, maybe doing the transaction today would work. But that's the math. The normal is for the futures price to be higher than the spot price. That's the normal. You may know what that's called. I think it's on the next slide. Contango, have you ever heard that word before? Contango. So when the futures price is above the spot price, that's contango. That's normal because you expect that. And for most things like the S&P 500, you're always going to have contango. Otherwise, you set up these arbitrage trades. So the S&P 500 futures, you only have one cost, and that's the time value money. If you buy the S&P today, you're out the money today. If you do the futures, you don't have to spend the money today, but you get it in the future. So that it's always going to be a little bit more expensive. Probably not much right now because interest rates, well, the last few years, interest rates were so low. It is possible for some assets be in backwardation, and that's when the spot price is higher than the futures price. And oil can go in backwardation. I do a case in my risk class where we talk about that, a firm that actually almost went insolvent because of backwardation. So now you might say backwardation, wow, that sets up an arbitrage trade, because I could sell oil today for $100 and promise to buy it back for 98. I made $2 without any risk. But how would you short oil? Kind of tough to do, isn't it? How do you sell? You can short the S&P 500. That's pretty easy to do. You just sell it. But shorting oil is really tough. It's hard to set up the arbitrage for this. So it doesn't quite work. Why do markets go in backwardation? There's a lot of papers on that. And that's not my expertise, but they do go in backwardation. And they go in backwardation in contango. It kind of depends on what oil prices are doing. Are they rising or falling? So there's some correlations you have to be careful of. But contangle's the norm. Backwardation is the unusual, but it does happen frequently, especially with some of these other assets. So the futures market is often far more liquid than the cash market. Oil futures are a lot more liquid than oil itself. In 2008, this was a disaster because in 2008, people were panicking. So they were selling, and they were selling their most liquid stuff. So futures got all out of whack because people were selling the futures because that's what they had to sell as liquid. And so we had some really strange. There was a few trades. I was tempted just to quit my job and just start trading because there was a few trades in 2008 that were just so ridiculously good. You know, I probably could have just put my whole portfolio in it and just would have taken off, but I didn't want to quit. I couldn't do it if I kept my job because they wouldn't let me do the trades, but there were a few. So 2008, because of that, you got some really wild markets. Y'all saw it in 2020 when all futures went negative. Y'all remember that? It was pretty wild. Why was that? Well, because there was no place to store their oil. So, you know, could you actually buy an oil future and they pay you cash? That's kind of a strange thing, but yeah, I mean, it was a strange. That doesn't happen very often. Although I think I saw they've had some issues with natural gas having some storage issues. So you can have some freaky things happen in these markets. So you have a choice. You can buy the oil today, or you can do the futures. And you can look at the return and see what the returns would be. They should be exactly the same. If your cost of carry is at $2, you should end up in the same. It should be indifferent between the cash market or the futures market. Same thing with the S&P 500, especially. You'll end up exactly the same spot. I won't go through that math. You can look at it. So futures market to me there's nothing crazy about it. It's just another way of getting into a market. It's liquid, it's quick. You can do a whole lot in a phone call. It's a lot easier to do futures than it is sometimes to do the cash market. With the S&P 500, I mean, you can go buy an index fund or you can do the futures. You know, those are two pretty easy things to do. So in some markets, it doesn't really matter. That's a futures. What is a forward? Well, a futures is an exchange traded transaction. Very liquid, very easy to set up, very standardized. A forward is an over-the-counter transaction, much more specialized. A swap is a forward. Swaps are over the counter. The futures, if you do a future, you don't have any choices. The dates, the strikes, all of that is set in stone, and you have no choices. With forwards and swaps, you can negotiate and get a contract that exactly matches you. So my first swap I did, it was pretty cool. I'd never done a swap before, and it's my day to trade. And I wanted to trade the 5-year treasury is up at like 5.25. And I wanted to trade because I was betting on rates falling. And I thought 5.25, that's a really high rate. So I called my swap dealer. And first thing he said is, what kind of swap do you want? So I wanted a 30-year swap, but I didn't want to have to do the quarterly cash payments. So he says, well, I got a 30-year zero swap. So that's how flexible it is. Got 30-year zero swap. So I don't have to do any cash. I don't have to do any quarterly payments. That's pretty cool. But I'm saying, well, how do I do a 30-year swap? I swap on a 30-year swap curve when my swap is only 5 years. But I had a 5-year swap on a 30-year bond. Everything was perfect. I got all the duration I wanted. It was perfect. So my first one swap transaction, I pick up the phone, I call this guy, and he's telling me, I think I can get a better deal. So the phone call took like 6 minutes, 7 minutes. It would have taken 30 seconds if I had done it. It's amazing how fast you can do these things. And that was on $3 billion. So 30 seconds, $3 billion. It's just like so fast. I thought, wow, this is really cool. And I sure hope I didn't mess up, because that would really be painful. So even with the forwards, the problem with the forwards is the contract. It took me 9 months to get the contract set up. Once I had the contract set up, the phone call was a few seconds. I mean, just, hey, I want to do 500 million notional, 30 years zero. This is how much duration I need. In my risk management class, I'll talk about how you figure out the notional amount. Pretty cool stuff. Most future contracts are settled in cash. So if you do an oil futures contract, you probably don't want them delivering oil to your house. So probably what you'll do is the day before it expires, you'll get out of the contract. So if it's up, you'll sell it and you'll get your gain. If it's down, you'll sell it and you have your loss. But you don't want that oil showing up at your house. Same thing with options. Most option contracts settle in cash. They don't actually expire. Okay, so that's a really fast through futures. I don't like futures. I like swaps. My brain doesn't think futures for some reason. I find swaps so easy to understand. They're but futures has always bothered me. Now, my CFA exam, part 2 of my CFA exam, they had one entire book that did nothing but proving that futures and swaps are the same investment. The entire book. They didn't ask anything on the exam about that book, but I had that book memorized. I was like, I mean, I couldn't do it today because it's been so long since I read it, but they showed mathematically a swap and a future are exactly the same transaction. But in my mind, they're so radically different just in the way they're structured. My mind has a tough time equating the two, but the book proved they really are the exact same thing. Have y'all heard of swaps? But you've probably heard of credit default swaps. That's the one that blew up in 2008. But I did interest rate swaps. You can do equity swaps. You can do all kinds of swaps. They're really, really cool things. If you want to learn swaps, take my risk management class. I think Catapacum teaches swaps in one of his classes. I think they're magical. They're wonderful things. All right, let's talk options then. We don't have much time, but all right. So an option gives you the right, not the obligation, but the right to buy something or the right to sell something. The right to buy is called a call option. The right to sell is a put option. And you have the right to buy or sell it at some future date. Sometimes you can only buy it at the expiration date. Sometimes you can buy it between now and the expiration date. Y'all can look that up, American versus European options. So are you buying or selling? What's the expiration date? And what's the price you have the right to buy it at? That's called the strike price. Now, does that have any value? So let's think about that. Let's look at Macy's since their stock's up a bunch today. So if you look right here, it has options. Let's go out a few months here. So Macy's has options. Macy's is trading for $22. Would there be any value of an option to buy Macy's at $30? You can buy them for $22 today. Would you want to enter into a 4-month contract that gives you the right to buy Macy's for $30? Does that have value? And the market says yes. You got to pay me 91 cents to do that. Why would you pay someone 91 cents to buy a stock at $30 when you can buy the stock for $22 today? And how did I get that 91 cents? Look at the option today. It's up 69%, 78%. Do you wish you had that option yesterday? How many of y'all made 78% on your investment today? It's really hard to do that, isn't it? Macy's isn't up 78%. They're only up 15% today. But the option's up 78%. So you can see you don't have to buy a whole lot of this to get the same thing you would have gotten on the stock. But look at this one right here. Up 86%. Look at that, up 100%. If you had owned that option yesterday, you would have made 100% today. And you would have known today was their earnings announcement day, so you expected some volatility. So the option was probably pretty expensive yesterday. They would have priced that uncertainty in there, but you still would have made 100%. So how often have you made? I've had options up like 40,000%. So they can move dramatically. What's the most this can go down? What's the lowest that number can be? 100%. Most you can lose 100%. So that's the nice thing about the option. So why would you like this option? Well, what if Macy's is trading for $35 in 3 months? You can buy the stock for 30 bucks, sell it for 35 bucks. You just made $5. And how much did you have to pay for that? You only had to pay 91%. That's a pretty good return too, isn't it? What if Macy's is trading for $29.99 in 3 months, 5 months? It's worthless. Your option expires worthless. But the second it goes above 30 bucks, now you got something because you can buy it for 30 bucks with the option and you can sell it whatever the price is. But the question is, why is this 91 cents? Why isn't it $2? Why isn't it 20 cents? We'll talk about that. How do you get these numbers? But that's what we mean by the right to buy, right to sell something, puts and calls. The higher the probability that option is going to have value to you, the more expensive the option is going to be. So if the premium is high, then that means there's a lot of volatility, but generally the premium is going to be well, it's always going to be much lower than the stock prices itself. So it's going to be a very levered bet. So they're extremely positively skewed. You can see just in that one option for Macy, you had an option up over 100%. You're already higher than your loss could possibly be. The most you could lose is 100. You've got an option that's up 100%. And how many days did that take? That was all today. One day, 100% in 1 day. So I'll show you. I think I still have GameStop, and I'll show you that. I put it out on Facebook, so I'll find the Facebook post. It was pretty dramatic because GameStop was trading for 20 something bucks. If you bought a $30 option on a stock that went to 400 bucks, do you think you made some money on that option? Just a little bit. Yeah, I mean, it's been a massive. Do you wish you had known that the day before? You could have, go to every relative you have. Give me all the money you have. We're going to become billionaires. It would have been really lucrative. All right. So Texas video, TXSVID. That's what we're going to cover next class. T, it's not for Texas. It's for time. X is for strike price. If you're a baseball fan, then use K, but then it's tickets video. But if you're a bowler, we use X. Now I had to tell you X versus K because you look at the Black-Scholes formula. Sometimes they use X, sometimes you use K. Depends if you're a bowler or a baseball player. S is the underlying stock price. V is volatility, maybe the most important one. I is interest rates, and then D is whether they pay dividends or not. So I asked, why is Macy's option trading for 91 cents? These are the 6 reasons why it's trading for 91 cents. So we'll start there next class.